Hello, everyone, and welcome to today's session. So, today we are going to start one very important topic, which is chapter number 13, group audits. Okay, now here in group audits, again, one important thing that I would like to highlight is that it is not a new kind of audit altogether that we are doing from scratch. No, we are applying the concepts of the audit in case of a group of companies. Okay, we are applying the concepts that we have already learned on the audit in the case of group of companies. When you audit in the case of a group of companies, when there's a parent company, when there's a subsidiary companies, okay, in that particular scenario, how we can provide or we can perform the audit, that is more important over here. Okay, in this session also what we will do is we will discuss the entire things which are there in the chapter number 13 with examples also. If you have your doubts, you can write it down. Okay, in the last 15 minutes I will provide the meeting ID. You need to join through that particular meeting ID and you can ask your doubts. Okay, but the request is, please follow me throughout the sessions till last 15 minutes so that you can understand what we are discussing over here and you can write it down your queries which are there. Okay, so let's start discussing this particular topic. Now, as I said, chapter number 13, group audits, it is something that we are applying the concepts of audit. It's not something new that we are learning from scratch and some new kind of audit altogether. No. Okay, it's the concept of the audit applicable to a parent and subsidiary company audit. Now, when I talk about the weightage, chapter number 13 basically fall parts of the section 3. Now, section 3 contains chapter 13 to 17. Okay, and it carries a weightage of 17% to 24% of marks. Okay, so 17 to 24 marks weightage it is there for the chapter number 13 to 17 in combined, which includes your group audit, which includes the audit of banks and NBFCs, public sector audit, internal audit, due diligence, investigation, and forensic. So in total, this entire section carries the 17 to 24 percentage marks. Now, if you understand the concepts of audit, it is pretty easy to apply those concepts for the purpose of group audits. Now, when I talk about group audits, what is group audits? Group audit basically is the audit of, okay, audit of consolidated financial statements. Okay, audit of consolidated financial statements. Now, I'll show you one example, a public report, annual report, which is there in the public domain. Okay, and how the consolidated financial statements are presented in that. See, these are the information which are available in the public domain. So I would request not to focus on the name of the company, but these reports are something which will give you a good understanding that how in practical life also these these audit works. Okay, so this is an independent auditor's report. Okay, independent auditor's report. But see one thing, this report is on the consolidated financial statement. Consolidated financial statement. This is the important part because when we do the audit of a consolidated financial statement, okay, we are talking about group audit, audit of a consolidated financial statement, which includes your multiple subsidiaries, parent, and a group of companies. Now, the way we have an audit of standalone financial statement, in a similar sense, we have an audit of consolidated financial statements. Why so? Can anyone tell me what is the reason of having a separate financial statement on a consolidated basis where it is written? That is very important to understand from where the requirement comes and why we are preparing this. why it is getting audited, where the audit requirement comes from. Anyone? If you know your answer as of now, write it down, because right now I will tell you the answer, and you need to see whether your answer is correct or not. Okay. Now, when I talk about audit, when I talk about the consolidated financial statement, the answer lies to section 129 of the Companies Act. Okay, section 129 of the Companies Act provides that where the company has one or more subsidiaries, okay, at that point in time, one or more subsidiaries, at that point in time, in addition to the financial statements, which are standalone financial statements, the company is required to prepare consolidated financial statements of the company and all the subsidiaries in the same form and the manner as that is its own, which shall be laid before the annual general meeting of the company. Okay, along with the standalone financial statements. Plus, the company shall also attach with its financial statement a separate statement containing silent features of the financial statement of its subsidiaries in such form as may be prescribed. Can anyone tell me what is this, format of the form which is there? Just write it down and see if your answer is correct or wrong. So, the format in which the silent features of the financial statement of the subsidiary is covered, it is nothing but your form AOC1. In the form or the format AOC1, this is required to be prepared. I'll show you in a while, don't worry. Okay, so this is AOC1. Now, from here, the requirement of the preparation of the consolidated financial statement comes into the place. Where is the requirement for auditing? Where is the requirement for the auditing? Anyone? Write it down and check what I'm going to show you. So there is a 129.4, section 129 subsection 4, which says that the provision of the act applicable to the preparation, adoption and audit of the financial statements of the holding company shall apply in a similar manner to the consolidated financial statement referred in subsection 3. That means once section 129.3 says prepare the financial statements, 129.4 says whatever is applicable to the standalone financial statement with respect to the audit is also applicable to the consolidated financial statement which you prepare. That means here the requirement of audit comes from 129 subsection 4, audit of the consolidated financial statements. So that's why when we see an audit report, in case of a, you can say, consolidated financial statement, I'll show you. Okay, we write that information required by the Companies Act. Okay, we provide the reference of the Companies Act because Companies Act says that we need to prepare consolidated financial statement and that is required to be audited. So we means company is required to prepare this consolidated financial statement and that is required to be audited. Now, when I say this is required to be audited, we have seen 129.3 and 129.4 from where the requirement is coming. Another question you might have, sir, if it is required to be audited, if it is in the similar manner, the way we have our normal standalone financial statement, why do we need to understand the audit of a consolidated financial statement? What is the need of this? What difference it will make? The way we are preparing separate financial statement, we will prepare a consolidated financial statement. Simple. No, it's not that same. Because the way the consolidated financial statements are prepared, you need to consider the financial statements of all the subsidiaries. Okay, you need to consider these financial statements of all the subsidiaries. And it is given, see, prepare a consolidated financial statement and of all the subsidiaries in the same form and the manner. Okay. Now, when I say same form in the manner, that means we have to consolidate. But what about the intergroup transaction between the subsidiaries and the parent? What about the transactions which are common in the parent and subsidiary? What about the transactions which are recorded because there's a separate accounting standards or financial reporting standards which are being followed by the different companies, different accounting year? When we talk about consolidating these financial statements, at that point in time, these all questions comes into the place. What about the differences between the financial statements? How can we add a apple and an orange? So one financial statement of a holding company can be an apple, and one another can be an orange. Can you add apple to an orange together? No. So we need to make those financial statements in line with one another. Then only we can say that, okay, now we can compare apple to apple and we can add and prepare a consolidated financial statements. Okay. So till that time they both are not comparable, you cannot add it. You cannot prepare a consolidated financial statement. And that is the responsibility. Preparing the consolidated financial statement is a responsibility of the management. Remember, section 129 financial statement, it places the responsibility on the management. Okay, it's not on the auditor. Auditor is not required to prepare consolidated financial statement. Management is required to prepare. So this is the responsibility of management. It is the responsibility of the management to prepare a similar, kind of consolidated financial statement, like basically which can be, added, and then all the subsidiaries financial statement can be added and then a consolidated can be prepared. Okay. So that is one thing. Now, what is the responsibility of the auditor in this regard? Okay, this is required to be audited. Is there any specific auditor's responsibility? Is there any specific responsibility of the auditor? Yes, it is there, because when we say audit of a financial statement, when you are appointed for an audit of a consolidated financial statement, you have to treat that, okay, you are auditing a separate financial statement, and you need to apply all the concepts that you have applied in the audit of a separate financial statements. All the concepts, starting from planning to materiality. Yes, you can leverage some of the work which you have done for the separate financial statement in the consolidated financial statement. Having said that, you have to consider from the start to end, basically all the concepts. Okay, and you need to see whether and how it can be applied in case of a consolidated financial statements. Okay. Now, very important part is that when we talk about audit of a consolidated financial statement, okay, it may be a scenario that there are some different auditors involved. It can be a scenario that you are the only auditor which is there. So we have to see both of the scenarios when we are the auditors or when there are other auditors into the picture. Okay, we will see that in a while. But as of now, just remember. And let me show you. Let's first understand few things. Let's say I'll prepare few companies over here. One, this two, this three, this four. Okay. So now we have a company one, company two, company three, and company four. They are purposefully having different size because their operation may differ. Each company may have a different size of operations. Okay. So let's say that we talk about some numbers, key numbers, turnover. The turnover for the company one, let's say, is of 100 crores. Company two, let's say 300 crores. Okay, we are as of now talking INR. I'm not introducing any other currency as of now. Not making much complicated, just simple numbers. Okay, here let's say 700 crores, and here let's say we have 120 crores. Okay, then we have a net worth. We have a net worth of, let's say, 50 CR. We have over here 250 CR. We have here 500 CR, and again 50 CR. Some numbers are given. Now, let's say this is the holding company. C1 is holding, and rest are subsidiaries. Okay, rest all are subsidiaries. So S1, S2, and S3. Now, when you prepare a consolidated financial statement, or when the company prepares a consolidated financial statement, they will total up everything. They will, prepare a consolidated financial statement by totaling up all the numbers. You being the auditor of holding company, let's say when you audited this 100 crore financial statement, P&L, and 50 crore balance sheet, can you apply the same materiality to the total? Let's say when I talk about the CFS, when I talk about, let's say, the CFS, consolidated financial statement, how much turnover it will have? 400, 4 and like 700, 11, 12, 12, 20 CR. Okay, and the net worth, assuming there are no intercompany transaction as of now for elimination, assuming that 50 to 300, 800, 850, 850 CR. So the materiality which was calculated based on the standalone financial statement, let's say I had a materiality over here, okay, overall materiality, which was calculated, let's say 5% of turnover, or not even 5, it's very high. Let's say 1% of turnover. So it was 1 CR. That was overall materiality, 1% of turnover. Can I apply this materiality to consolidated financial statements? No, I cannot. Can I apply this materiality to individual financial statements of subsidiary? No, I cannot. It will not match. It will be either too less or too high. It will not be in proportionate to the materiality that we have calculated in as per the C1. So that's where it becomes very important to understand when you are auditing a consolidated financial statement, you need to apply the audit concepts as per this number, as per this base, as per these financial statements. So whatever work I have done on the holding or a separate financial statement may not be relevant, considering how much of the portion of the holding is there in the consolidated. Let's say if the holding is 80% of the consolidated, it will be relevant. So a lot of work that I have done in the holding audit will be relevant for my consolidated. But let's say it is only, like in this scenario, it is only 8% somewhere. Okay, the holding is 8% of CFS. In that scenario, I need to perform some more work to get the comfort on the numbers of the consolidated financial statements. Okay, that's where it becomes a separate topic. That's where it becomes very important to understand what we need to do to get the comfort on the numbers of the consolidated financial statement. And we need to apply from the planning to the execution everything again on the basis of the consolidated financial statements. Now, when I say planning to execution, it's not something different that you applied in the separate financial statement. I'm talking about same SA 200, SA 240, 250, 260, 265, communications, everything I'm talking about same. SA 300, 315, risk assessment, 330, assess response. Okay, SA 500, audit evidence. All these things you have to apply in a similar fashion to the consolidated financial statement, even for the reporting SA 700 series, like 700, 701, everything. And to show you, see, this is audit report of consolidated financial statement. We have an opinion paragraph. We have a basis of opinion paragraph. We have key audit matters. This is nothing but SA 701. Okay, the key audit matters, the way they are preferred, the way are required to be reported. Other information, which essay, you can write it down and then you can check whether your answer was correct or not. SA 720. Okay, again, auditor's responsibility, the key features which are there in SA 700. In that also, when we are writing, we are specifying SA 700 elements. We are also specifying a lot of things with respect to the going concern, with respect to the other things. Okay, and other matter paragraph, a lot of things are there. And this part, section 143, subsection 3 and 11, we will see what is 11 in a while. But yes, section 143, subsection 3, which is applicable to a separate financial statement, you need to reply from the perspective of the consolidated financial statement in a similar fashion. Okay, in a similar fashion, you have to answer for that. All the things which are present in an audit report of a separate financial statement are required to be presented for the audit report of consolidated financial statements. That means you need to see and you need to gather that evidence for the purpose of reporting. Okay. Now, we need to, before we jump and deep dive how we can carry out the audit of a consolidated financial statement, let's first understand to whom it is applicable. You will say, sir, every company. We just now saw section 129 says that it is applicable like to company and all its subsidiaries. Okay, in the same firm, if the company has a subsidiary, it will be applicable. Yes, if the company has one or more subsidiary, the point is one or more subsidiary, it will be applicable for sure. Not an issue. Totally agree to your point. But there is something more to discuss. There is a rule 6. Rule 6 basically provides that, and when I talk about rule 6, okay, it's companies account rules. Okay, over there, when I talk about rule 6 of companies account rules, there is something specific provided. So in the companies accounts rule 2014, there is a rule 6, manner of consolidation of account, the way you should consolidate. Okay, what it says that the consolidation shall be made in accordance with the provisions of Schedule 3 of the Act and applicable accounting standard. Good. That means we are required to follow Schedule 3. We are required to follow accounting standards, like companies required to follow Schedule 3 and accounting standard when they are consolidating the financial statements. First proviso. First proviso 2, rule 6. What it says? It says that in case of a company covered under subsection 3 of 129, to which you have one or more subsidiaries, okay, which is not required to prepare consolidated financial statement under accounting standards. If you are not required to prepare consolidated financial statement under accounting standards and you are covered by this subsection, okay, covered by this subsection, that means you have a more than one subsidiary, one or more subsidiary. So this means you have one or more subsidiary. Okay, in that case, very important part, in that case it shall be sufficient for the company. Sorry, this is part very important. It shall be sufficient if the company complies with the provision on consolidated financial statement provided in Schedule 3 of the Act. Sufficient means you are not required to prepare a separate financial statement. Sufficient means you are not required to prepare a separate financial statement. This gives an exemption based on accounting standard. So there is an exemption based on accounting standard which says that if you are not required to prepare as per the accounting standard has given you the exemption, fine, do not prepare, only comply with the provisions of consolidated financial statement which are there in the Schedule 3. That means irrespective of the exemption, okay, you have an exemption with respect to the separate consolidated financial statement, but you have to comply with the Schedule 3. So Schedule 3 compliance is mandatory. It may be a scenario that you are not required to prepare a separate consolidated financial statement. So exemption based on accounting standard, okay, gives you exemption from CFS. Exemption from CFS only, not from Schedule 3. Fine, understood, very good. Now, which are the companies who are exempt under accounting standards? Let's talk about, as of now, NDS. Which NDS would be governing in this scenario? Which NDS is required to be followed? You write your answer and then check whether your answer is correct or not. I hope you have written the answer, like which NDS governs the consolidated financial statement and which companies are exempt. Okay. So the answer is, we will see for the exemption, we will see NDS 1110. What is NDS 1110? NDS 1110 talks about consolidated financial statements. Consolidated financial statements. Now, which are the entities which are exempt? So you need to go to the para 4. Para 4 talks about this NDS applies to all entities except below. Means the below entities are not required to prepare CFS. So these are exempted from CFS. So the below entities are not required to prepare. Which are those? A parent need not to present CFS if the following conditions are satisfied. Okay. And remember, when I say the following conditions, it is not the or, it is the and. That means you have to add all the conditions. You need to satisfy all the conditions. Okay. Meets all, very important part. This is very important over here. All conditions. Remember this point. Not anyone, not any selected condition, but all the conditions. Okay. Now, what are these conditions? Number 1, it is a wholly owned subsidiary or a partially owned subsidiary of another entity, and all its other owners, otherwise not entitled to those not otherwise entitled to vote, means who are not entitled to vote, basically. So all other owners have been informed about and they do not object to the parent not presenting CFS. Means parent plus all other owners agree that we will not prepare CFS. So if I talk about the summary of this point, parent plus other owners agree on not preparing CFS. If that is done, you have met your condition number 1. Number 2, debt equity instrument are not traded in public, domestic, foreign, over the counter market, okay, including local or regional markets. Wider, that means your debt or equity instrument should not be listed or traded, whether it is OTC, domestic, foreign, local, regional, whatever it is. Okay, wider markets, I will say wider markets for now. So debt plus equity, not traded in wider markets. Okay, third condition, it did not file, nor it is in the process of filing of its financial statement with the Securities Commission or other regulatory organization for the purpose of issuance of any class of instrument in public market. Very wide. It may be a scenario that your equity or your secure debt is not being traded, but you are listed. It can be a scenario that you are listed, but it is not being traded. So here it is specified that you should not be in process of filing for the listing also. So, and there the important part is any class of securities. If you see in point number 2, we are talking about debt or equity instrument. Debt or equity instrument. But here, point number 3 says that any class of instrument whatsoever. So all securities not in process of listing. Okay. Fourth and very important point, its ultimate or any intermediate parent produces financial statements that are available for the public use and comply with the IND-AS, in which subsidiaries are consolidated or are measured at the fair value through profit and loss account in accordance with this IND-AS. This condition means that there is another parent company, whether ultimate or intermediate. It can be any. What is ultimate parent? Let's say there is a ultimate parent 1, then there is intermediate parent, okay, 2, second company, then there is, let's say, intermediate parent 3, and then there is a holding company, okay, and then there are subsidiary 1, subsidiary 2, subsidiary 3. So you may not prepare financial statements, fine, but either your intermediate parent company like IP2 or IP3 or your ultimate parent company UP1 should be producing financial statements that should comply with IND-AS, available for public use, in which subsidiaries are consolidated or measured at the fair value. So either in the given example, as I explained, either ultimate or intermediate parent. So either parent should have IND-AS, CFS for public use. If all the 4 conditions are satisfied, then only the parent need not to present consolidated financial statement. Clear? Any question? If you have, you can write it down. But this is exemption which is given under para 4 of IND-AS 110. Okay, very important part, very important. Now if this exemption is given under para 4, okay, let's go back to our rule. Rule says that If you are not required to prepare, that means you fulfill 4 points, 4 conditions. So exemption from CFS based on accounting standard, Ind AS 110, 4 points. Okay, you can only comply with the Schedule 3. Do not prepare CFS. Perfectly fine. But what if we don't have the exemption from CFS under Ind AS? Then we will go to the second proviso. Okay, why? Because second proviso talks about another case, another class of exemption that says that provided further nothing in this rule, that means the rule which talks about manner of consolidation of accounts, okay, shall apply in respect of preparation of the consolidated financial statement by a company if it meets the following condition. Means second proviso gives 3 conditions. If you satisfy, this rule will not be applicable. That means you are not required to prepare the consolidated financial statement, okay, as per your applicable accounting standard or Schedule 3. Okay, what it is? Condition number 1. It is a wholly owned subsidiary or is a partially owned subsidiary of another company, and all its member, including those not otherwise, not otherwise entitled to vote, have been intimated in writing. Proof of delivery of such intimation is available, and they do not object to the company not presenting consolidated financial statement. Similar what we saw in the accounting standard. So this is same as condition 1 of Ind AS 110. Same as condition 1 of Ind AS. Very good. Second, the company whose securities are not listed or are not in process of listing on any stock exchange in India or outside India. Similar to same as condition 3 of Ind AS. And its ultimate or any intermediate holding company files consolidated financial statement with registrar in compliance with applicable accounting standards, Ind AS or whatever it may be. Okay, so same as condition 4 of Ind AS. Now you will say, sir, where is condition 2? See, if your securities are not listed, for sure they will not be traded. That's why here the condition 2 is not there. But again, if your Ind AS does not exempt you, you can get exemption from the rule. Are you getting the point? If Ind AS does not exempt you, you can get the exemption from the rule. But a question will come that, sir, if the Ind AS does not exempt, how this rule will exempt, or what will be the scenario where I don't have an exemption from the Ind AS, but I do have the exemption from this rule? Okay. Basically, see, in that particular scenario, it can be a scenario, I'm just giving you, it can be a scenario where Ind AS is entirely not applicable to you. Ind AS is not applicable to you. So you will say, sir, if Ind AS is not applicable, then basically AS will be applicable. Yes, AS will be applicable. Okay. So AS again provides a different set of conditions. We'll not go as of now in the AS part, but understand that basically when I talk about exemption, there could be a very small scenario where Ind AS is not applicable, AS is applicable, you are required to prepare as per the AS, but again you satisfy all these conditions. In that scenario, you can get exemption. Okay. Now a very small window where you can take a benefit of this rule and get the exemption when Ind AS is not applicable to you, and because of some reason you are not getting exemption under the Ind AS. Okay, but these two exemptions, when I talk about whether it's a first proviso or the second proviso, they provide the exemption from the preparation of the consolidated financial statements. However, there is one small thing which is, you can say, or you can raise a concern over here is, see, when I talk about first proviso only exempt you from the preparation of the CFS, not required to prepare CFS as per the accounting standards. Fine, you are not required to prepare CFS. Second says that this entire rule will not be applicable to you. The entire rule will not be applicable to you. That means, are you required to follow Schedule 3 in that scenario? What do you say? Are you required to follow Schedule 3? Yes, no. Are you required to follow Schedule 3 in that particular scenario? Just write it down. In that particular case, a question can be, it may not be. Reason, because Schedule 3 talks about, like, Schedule 3 requirement comes from the Rule 6. Okay. Rule 6 says that you need to follow Schedule 3. But if I say the entire rule is not applicable, Schedule 3 will also not applicable. So it's a full exemption from this rule. Okay. So this particular provides full exemption. Okay. So that is one part of the exemption that we have discussed. There is one more area where the exemption is applicable. There is one more area where you can get the exemption, where the accounting standards, doesn't require you to prepare consolidated financial statement. Can anyone tell me which is that? Just write it down as of now, and then tell me what is that particular area where you are not required to prepare consolidated financial statement. Just write it down and then tell me. When I will discuss the answer, then you can compare whether your answer was correct or not. Okay. So one particular area where the consolidation is also not required, again, we will go to the Ind AS 1110 only. Just a minute. So that is your investment entity. Let me go to the page. Yeah. Page 27. Just give me a minute. Determining whether an entity is an investment entity or not. Very important paragraph. Why? Because when I talk about investment entity, okay, investment entities are not required to prepare consolidated financial statement. Rather, investment entities are required to measure the subsidiaries at the fair value. Very important, paragraph 31 of the Ind AS 110. What it says that except described in 32, an investment entity shall not consolidate its subsidiaries or apply Ind AS 103 when it obtains the control of any other entity. Instead, investment entity, okay, shall measure an investment in a subsidiary at the fair value through profit and loss account in accordance with Ind AS 109. Okay, that means investment entity is not required to prepare consolidated financial statements, shall not consolidate the subsidiaries. So another exemption which is given in Ind AS 110. of the investment entities. So you can say that this is investment entity exemption. Okay. Now, which entities you will classify as an investment entity? Which entities you will classify as an investment entity? Is there any condition? Just write it down as of now. We will see. So, the conditions are also given in Ind AS 110. Para 27 talks about that whether an entity is an investment entity or not, you can determine by the conditions which are given in para 27. There are three conditions. Condition number one, an investment entity is an entity that obtains funds from one or more investors for the purpose of investment management services. So providing those investors with the investment management services. If there is an entity which is providing this services and obtaining funds, it is meeting the criteria. Okay. Commits to its investors that its business purpose is to invest funds for returns from the capital appreciation and investment income, or both. And so again, when I talk about and, so these are the additions. It is not something that you need to satisfy any one condition. No, all the conditions. Measure evaluates the performance of this substantial or all of its investment on fair value basis. So if you obtain funds from investors for the investment management service, you invest funds for returns like capital appreciation and investment income, or both, and you measure and evaluate the performance on fair value basis, performance of the investment, okay, in subsidiaries or in any other entities, then if you satisfy these conditions, you become a investment entity. Now, investment entities are not required to consolidate its subsidiaries or apply Ind AS 103 when they obtain the control. Instead, they are required to measure the investment at the fair value in accordance with 109. Now, there was one scenario that except as described in para 32, investment entities is not required to consolidate. What para 32 talks about? What is this exemption we are talking about? Like, what is this para 32's requirement? Now, para 32 basically talks about that how a subsidiary of the investment entity is required to operate with respect to the consolidation. Okay, so it says that if an investment entity has a subsidiary that is not itself an investment entity, remember, so investment entity has a subsidiary which is not itself is an investment entity. That means it's a normal business operating subsidiary whose main purpose is not to provide, whose main purpose and activities are providing service that is related to the investment entity's activities. It shall consolidate that subsidiary in accordance with the paragraph 19 to 26 of this Ind AS and apply the requirements of Ind AS 103 to acquisition of such subsidiary. Means it is not an investment entity, but its purpose and activities are providing service that relate to the investment entity's investment activities. Two things. So there is an investment entity. One, there's a subsidiary of its investment entity. Now, this is not an investment entity. That means not satisfying three conditions. Okay, not satisfying three conditions. But its business okay, or its main purpose is to provide service that relate to the investment entities investment activity. So it provides service which relates to this entity's investment activities. If that is a scenario, consolidate that subsidiary in accordance with paragraph 19 to 26 in a normal way, and NDS, and apply the requirements of 103. Why? Because here, this entity which you have acquired, here the main purpose of the entity is to provide the investment entity the service. It is not for the purpose of capital appreciation. It is not for the purpose of getting return income from this entity, but this entity will support the investment activities of the investment entity. That's why you are required to consolidate. Logically, if you see, I acquire an entity which will help me in my investment activities. The purpose is not to get the return from this entity. The purpose is not to get stock appreciation from this entity, but this entity will help me. Yes, I have other investments where the purpose is to get the capital appreciation, or let's say interest income or the dividend income. But for this entity, this purpose is not applicable. So where it is not applicable, I need to consolidate that. Okay. So that is a particular part of the investment entity. Investment entity exemption not applicable in this scenario. Otherwise, there is another exemption to the investment entity. So 129 rule 6. Rule 6 talks about exemption. Now we saw the exemption from the accounting standard. Either it is 4-pointer based or investment entity based. Okay, under the first provision. If any of the conditions, or because of the any of the reason you are not getting the exemption from the accounting standard, you can go to the rule and ask for another exemption which is there in the second provision. If you get, you are not required to comply with the rule 6. Clear? If you have any doubts, you can write it down, and then we will discuss once we will open up the channel for the discussion. Okay, that is pure who is required to prepare the consolidated financial statement. Pure who is required to prepare the consolidated financial statement. Why? Because as an auditor of an entity, you should be aware whether the entity that you are auditing is required to prepare the consolidated financial statements or not. You are required to audit the consolidated financial statements, because rule section 129 says that audit is required. If the audit is not happening, you need to highlight there is a non-compliance with law or regulation. Okay, so very important to understand whether the entity is required to prepare the consolidated financial statements or not. Okay, that is the first part. Responsibility of the parent company. Now we have understood the responsibility of the parent company with respect to only preparation. This is the first part, responsibility of the parent company. Now responsibility of the parent company with respect to the applicability. Now second will be preparations, and we will see what are the preparations, what is required to be done by the parent company, and then we will come to the responsibility of the auditor. Okay, now what is the requirement of schedule 3? Because we saw rule 6. Rule 6 says that you need to follow the provisions of schedule 3. Okay, what schedule 3 says, that is something we need to understand. Okay, so let's go to the schedule and let's understand what schedule 3 says. Basically if you guys are aware that schedule 3 is divided into two parts or three parts: division 1, division 2, and the division 3. We will see the requirements which are there in the division 1 and division 2. So when you pass through the general instructions for the balance sheet, general instructions for the profit and loss in schedule 3, you will come across something called general instructions for the preparation of the consolidated financial statement in schedule 3. Now this is division 1. For your reference, this is division 1. You should be aware to whom the division 1 is applicable. Okay. What this says where the company is required to prepare consolidated financial statement, that is consolidated balance sheet, profit and loss account. Okay. The company is also required to follow the requirement of this schedule for while preparing the balance sheet and profit and loss account. Okay. And shall disclose the following information as per the requirements. Now, the following information is required to be disclosed as applicable in the accounting standard. Like, what is the following information? Number 1, profit and loss attributable to the minority interest and to the owners of the parent in the statement of profit and loss account. So you need to disclose profit and loss account attributable to the minority interest. Second, minority interest in the balance sheet with the equity shall be presented separately from the equity of the owners of the parent. So you need to disclose minority interest separately. Let us see.
Hello, sir.
Yes.
Sir, sorry to disturb you. Ajit.
Yes.
Sir, we have sent a chat on a message. Please, sir, please announce.
Okay. So our BOS knowledge has started working. So students who want to interact with us can follow this procedure. Log into the BOS knowledge portal, okay, with your credentials. Over there, go to the Zoom, join Zoom May 2027 exam, okay, and then you will get a link for join Zoom. Over there, you can join and you can join this particular session. So the knowledge portal, BOS knowledge portal, has started working. You can go to that portal, log in the portal with your credentials. Okay, over there you will get an option of join Zoom May 2027 exam, and over there you will get a link for join Zoom. Once you will click on that particular link, you will be able to log in or able to join this particular session. Okay, so please take the benefit and join the session so that we can discuss and we can you can ask your queries now. So here, right here, you don't need to wait for the end 15 minutes. You can join right now. Okay, you can join right now by following these procedures. Again, go to the BOS knowledge portal with your go to the BOS knowledge portal, log in with your credentials. Over there you will see an option of join Zoom May 2027 exam, and there you will get a link for join Zoom. Okay. So meanwhile, let's continue the discussion. So what we were talking about? We were talking about general instruction for the preparation of the consolidated financial statement. Now we were talking about that along with the consolidated balance sheet and P&L, this is required to be done. Profit and loss attributable to the minority interest, and then minority interest in the balance sheet with the equity. Okay. So profit and loss account attributable to the minority interest and minority interest in the balance sheet, that is required to be disclosed. Now let's see an example of a public report, public annual report, and how it is being disclosed in that. So let's go to the example. This is again information which is there in the public domain, taken for the discussion purpose. Please do not focus on the name of the company. So what is said is that you need to disclose minority interest in the capital, and you need to disclose profit attributable to the minority interest in the P&L. So over here, let's see. This is your profit and loss account. Apart from that, we will go down. Let me rotate this. Yeah. Now these are the reserves and other components of the equity. Okay. Then you have equity capital. Yes. Okay. So you have a other reserves and you have a equity part over here. Okay. Now, if you see over here in this, so what our requirement was, let's go through that and understand, and over there, then we'll come back and see over here. So the requirement was that in minority interest in the balance sheet with equity shall be presented separately from the equity of the owners of the parent in division 1. Okay, and again, profit and loss attributable to the minority interest to the owners of the parent in statement of profit and loss account shall be shown separately. Now this is division 1. We were seeing this financial statement as per the Ind AS. Sorry, basically we are seeing this financial statement, they are as per the Ind AS. Ind AS means division 2. So over there was division 1 and this is division 2. It will not match. We will see the same requirement in the division 2. How division 2 says for this. See what division 2 says. Instead of minority interest, now it says that the term has changed. Profit and loss attributable to the non-controlling interest. Profit and loss attributable to the non-controlling interest and the owners of the parent in the statement of profit and loss account shall be presented as an allocation for the period. Further, total comprehensive income for the period attributable to the NCI and owners shall be presented in the statement of P&L as an allocation for the period. The aforesaid disclosure for the total comprehensive income shall be made in the statement of changes in equity in addition to the requirements of the Ind AS. Okay. So that is the one thing. Now we are not using the term minority interest. We are using the term non-controlling interest. Second, in the balance sheet, you need to demonstrate non-controlling interest in the statement of changes of equity within the equity. And you need to show investment accounted using equity method. These are the things you need to disclose separately. So in our example that we were seeing, okay, so let's see the statement. Just a minute. It is a very big document taking time to render. Just give me a minute. Okay, yeah. So this is the balance sheet. Okay, what it was said is you need to disclose first of all when you're talking about in the balance sheet, you need to disclose with respect to the non-controlling interest. Okay, we'll go below consolidated balance sheet over here. Okay, just we will go below statement of changes in equity over here. Okay, and in this particular scenario, if you see, this is the entire statement of changes in equity. Now here in this scenario, you basically don't have a non-controlling interest, but still what they have done is they have identified for the owners of the company. If you have a NCI, then you will reflect the NCI. Otherwise, they will show the transaction with the owners. So here they have specified the transaction with the owners. Okay. Similarly, if there is NCI anywhere, they will show the NCI portion. Otherwise, they will show the transaction with the owners only. Okay. So this is the entire company. This is company here. In this company, there is no minority. That's why they have not shown. But if there is minority, they will show for it in the statement of changes in equity. Okay. So that is the first requirement. Second requirement, in the consolidated financial statements, you shall disclose by way of the additional information. This is something you need to show as an additional information. What is this additional information? Name of the entity in the group, net asset, total asset minus total liabilities, as a percentage of consolidated net assets, share in profit and loss, share in other OCI, share in total comprehensive income. Okay, again, percentage of comprehensive income, amount. This is a tabular format you need to show for subsidiaries, which are Indian, foreign, non-controlling interest in all subsidiaries, associates, investment as per the equity method, Indian and foreign. Okay, and joint venture, investment as per the equity method, again Indian and foreign. Now let's see in our example what is there. So we have this reporting which is done as per the schedule 3, where you have a name of the enterprise, net asset minus total liabilities. Okay, total assets minus total liabilities, which is the percentage of consolidated net asset, amount in crores, profit and loss, other comprehensive income, total comprehensive income, plus you have parent, subsidiaries, which is Indian and foreign. Okay, then you have joint operations, again Indian. You have joint ventures, investment as per the equity method, Indian. If there will be foreign, that will be reported. Again, you have an associate, investment as per the equity method, Indian, and then foreign. And then you have a subtotal over here. What is another requirement? So this table is present. Okay. Then what additionally it is required to disclose? All subsidiaries, associate, joint venture, whether Indian and foreign, will be covered under the consolidated financial statement. An entity shall disclose the list of subsidiaries, associate, or joint ventures which have not been consolidated in the consolidated financial statement, along with the reasons of not consolidating. So if there are any entities which are not consolidated, you need to disclose the list for an entity which is not consolidated. If there is anything with respect to, like, you're not consolidated, okay, then you need to provide that. Okay, so let's see that particular reporting. Now, as I said, remember there is something called AOC1, silent features. Remember, we discussed under section 129.3, read with rule 5, where we talked about AOC1. There is a silent features, AOC1. So this is AOC1, reporting in your financial statements related to subsidiary companies. Okay. Now, this is how the AOC1 reporting is required to be done in the financial statement, where you have the name of subsidiary, date when it was acquired, country, reporting currency, exchange rate, and all the relevant details of that particular subsidiary. Okay. Over there, so if you see, this one, part B. Over there, we have certain entities, joint operations, joint ventures, associate. And we have something called here reason why they are not consolidated, reason why the associate joint venture is not consolidated if they are not. Okay, in entire, like if this is not consolidated, then the reason thereof. There is no reason as of now. That means they are not considered, like there is no reason why they are not consolidated, means they are consolidated. If there is something which is not considered for the consolidation, it will be reported in these columns. These are blank, means everything is considered for the consolidation. If there is anything which you have not considered for the consolidation, it is required to be reported over here. Okay. Here we have everything consolidated. So nothing is as of now not consolidated. That's why it's nothing over for the reporting. But if anything will be there for the not consolidation, in that scenario, you need to disclose separately. Okay. So this is requirement of the finance of the schedule 3 plus section 129(3) in the financial statement. Why it is important for us to understand? Reason because this is necessary for an auditor to understand, to ensure whether the appropriate, this is part of now financial reporting framework. Plus presentation disclosure of FS. This is very important. How can you ensure that the presentation and disclosure of the FS and the financial reporting framework is followed appropriately or not? If you are not aware about the requirements of the reporting. Okay. Any doubts till now? You can unmute, you can ask your doubts. Any doubts? You can unmute and ask your doubts. Okay. Okay. If no doubts, then we discussed now two things. One, what is there with respect to the schedule 3? Okay. Plus, what is the presentation that is required to be done? Same was applicable for the schedule 1 or division 1 also. We saw the division 2. Division 1 also requires this kind of presentation. Okay. So that is only the difference is minority interest plus the non-controlling interest part. Now, that is one particular part that we have discussed with respect to the financial statements. Okay, now we need to discuss about one very important part. What is the responsibility of the parent with respect to preparation of the consolidated financial statement? Now, responsibility of the parent is, first of all, they need to decide whether applicability is there or not. Perfectly fine. You decided the applicability, whether the consolidated financial statement is applicable or not. Then comes the preparation. You will understand how the preparation is required to be done so that you can audit it. Okay. Now we will go towards more on the preparation and the audit of the consolidated financial statement. See, when I talk about preparation and the consolidation of the preparation and the audit of consolidated financial statement, basically preparation is kind of responsibility of the management. They are required to prepare by passing the relevant adjustments. There are two type of adjustment we will discuss in detail, and then the auditor's responsibility is to perform the audit and perform the audit of those adjustments also. So it is not only the financial statements that you need to audit, it is the how that financial statements are derived, plus a scenario where we need to understand whether the financial statements which are consolidated are audited or not. Okay. And then comes the reporting part at the end. So we will see the preparation by the management, we will see the audit done by the auditor, we will see then the reporting part. This is how the hierarchy will work: applicability, preparation, audit, and then reporting. Okay. Now, when I talk about preparation, and I, as of now, I would require answer from your sides. Okay, answer from your side. Let's suppose you are required to prepare consolidated financial statement. What is the first step as management you would perform? First step as management that you would perform. Yes, quickly. I want an answer from your side. You can now unmute and answer to me that what is the first step that as a management you should perform. Anyone? Pretty simple, trust me. What is the first step? No? The first step as a management will come into the picture that how you are ensuring that you have identified all the components, all the subsidiaries. Okay. How you have identified all the subsidiaries. So the responsibility of parent is not only to prepare, like, okay, I have these three, I know I will identify. No, you need to understand, first of all, that as a parent, as a management, the responsibility is to identify the components. The first step will be to identify the component for consolidation. Now, when I say component, you can say subsidiaries, you can say joint ventures, you can say associates, okay, you can say joint operations. So there are multiple structures possible. So there should be a mechanism with the management to identify that, okay, as a management, now we are talking about preparation. Now we are talking about preparation of the consolidated financial statements. The first step as a management is to identify that how the component, like, is identified, or how can you ensure the completeness of the component list or the subsidiary list. So here I need comfort over the completeness assertion. Identify means completeness. Okay. That how can I ensure that I have identified as a management all the components that were required to be consolidated. That were required to be consolidated. Now, why that is necessary? Because if I miss a single component, my consolidated financial statements are incomplete. My consolidated financial statements will be incomplete. So first, I have to identify that which are the components that are required to be consolidated. And how will I identify? Anyone? What criteria I will use to identify? How do you identify like which entities are required to be consolidated? Come on quickly. As a management, what do you think? Which criteria management should use or apply to identify that which components are required to be consolidated? From where I will get that criteria? I cannot go and pick any company. Okay, now I will consolidate you. One is subsidiary. You will say more than 50% holding. I will consolidate. Subsidiary, it's my subsidiary. Is there any other criteria? Understand whatever we are discussing, there is a relevance for that. If we are discussing from the side of management, because you will then audit that side. So you should be aware that whether the steps which have been taken by the management are correct or not. So it's not something we are just learning from the side of management. No, as an auditor, we should be able to evaluate that the procedures, that the methodology followed by the management are appropriate or not. Okay. So the question comes is, what criteria? And the answer is nothing but your accounting standard. What your accounting standard? We will go to Ind AS 110. What Ind AS 110 says? That if an entity controls one or more other entities, present the consolidated financial statement. The criteria is control. Simple. If you control, prepare the consolidated financial statement. And there is a criteria given. What is control? So tomorrow, if management says, no, I only control more than 50%, if I have investment more than 50%, I have only taken those entities. Your first question, why? Why you are not considered the other components of the control? So here you need to determine whether the entity controls. Okay, and when I say control, that if you have a power over the investee, exposure to the rights to the variable return, ability to use over power of the investee, okay, to affect the investor's return. If you have all these things present, you can have a control. Again, there is a definition of the power, link between power and return. Okay. Then comes the non-controlling interest. That's where the term non-controlling is there, because you don't have a control. So the question comes is, what criteria is being used by the management to identify the components? So to ensure the completeness, you need to also understand the criteria. To understand the completeness, understand the criteria used by management to consolidate, or to identify, basically, even to identify the component. Clear? That is the first and foremost thing, because then only we will be able to understand that, okay, what is required to be audited. First, we will start with that, identifying the components, including the financial statements of the component to be included in the consolidated financial statement. That's the first thing. Clear? Now, after identifying this, what will be the next second step? What will be the second step? I will identify. Once I have identified the component, the second step will be identify the financial statements of components. okay, which will be consolidated. Now, very important question. Why we need to identify financial statements? Why we need to identify financial statements? Anyone? Why we need to identify financial statements? So the answer again lies, yes, very good. Very good, Piyush. So the answer again lies basically that what sort of statements we need to consolidate. Again, a publicly available information. I will show you something. Okay, it's a publicly available. It's an entity which is listed outside India. Okay, and we will see the financial statement of that entity so that we can understand why it is necessary to identify the financial statements. I would recommend do not focus on the name of company as of now, please. Okay, because again, it's a publicly available information which is there, and it is for the purpose of understanding that we are going to do over here. Let me. So it's opening up. Just give me a minute. Mhm. Sorry for the glitch. Just give me a minute. I think it's stuck. Okay, let me reshare. Okay. So we will go to the financial statement of this particular company to understand how it is prepared and why we are identifying a financial statement. Okay. Because this will help us to understand that how financial statement can be different from one particular company to another particular company. See, these are the financial statement of this particular company. So you have a consolidated P&L and other comprehensive income. You have a statement of financial position, not the balance sheet. You have a statement of financial position, not the balance sheet. It may have similar things, but not. Statement of changes in equity. Statement of changes in equity. Okay. You have a statement of cash flows, similar to Indian version. This is company registered outside India, not in India, in a different format. So you have something different now. We have seen statement of cash flow, which is similar, but we have a statement of financial position. Okay. Unlike the version we have over here, instead of statement of profit and loss account and balance sheet, we have a financial position. In some other jurisdiction, if a company is incorporated somewhere else, over there you may have a different set of financial statement, different set of statements which are required to be consolidated. So you need to first identify what to consolidate over here. Okay, what should I have to consolidate? Then accordingly you will be able to consolidate. If you do not understand what is required to be consolidated, you will not be able to consolidate then. If you do not know what are the financial statement or set of financial statement, it will be very difficult for you to consolidate. So identification of the financial statement is the second important step. First step, identify the component. Second step, identify the financial statements so that you can consolidate. If you have this number with you, then only you will be able to consolidate. Otherwise, you will not be able to consolidate. If you have this statement with you, then only you will be able to consolidate. Otherwise, you will not be able to consolidate. Clear? So that is the second step. Any doubt till now? Any doubt? No? No doubts? Okay. If no doubts, let's take a quick 10-minute break. Okay. Then after the break, we will gather further. We will gather and discuss further on the preparation of the consolidated financial statement and their audits. Okay. Let's take a quick 10-minute break. Vivek ji, break start. Break. let's continue the discussion. Hello everyone, welcome back. Let's continue the discussion. So what we were talking about, that how to identify, like, which components are there. So control is a criteria. Second, identify the financial statements of the component which are required to be consolidated. As I just presented that, there could be a different set of financial statement for different components. Okay. So in that particular scenario, you need to understand that which are the set of financial statements that are required to be consolidated. Fine. So I identified basically the consolidated financial statements of the component. Okay, fine, not an issue. Now coming to the next part, once I identify the components of the financial statement of the components, I need to understand basically that what are now the segments that are required to be reported. Okay, segments that are required to be reported. Because why? Reason because is that the segment that we are talking about may be different based on the different geography, different jurisdictions. So accordingly, we need to identify the relevant segment. At the end, you are required to do a segment reporting also. Yes or no? So you need to understand which segments are there. Not only the financial statement, but the segment reporting is also now important. Once you identify the segment, then only you will be able to identify that now these are the segments that you need to report, you need to consolidate. Okay, so the third step is a segment reporting. Segment identification and reporting. See, we will go back to our example of public listed financial information that we have, and we will see how segment reporting is done over there. Okay, with respect to the consolidated financial statement. So just a minute, segment reporting. Now this is again yeah, management discussions segment. See, again, like here it is part of the management discussion. Let me see some more segment reporting. Yeah, over here we have, this is part of the consolidated financial statements. Okay, now we have segment reporting done by the management for the consolidated financial statement. See, we have various segments. So commercial vehicle, corporate unallocable, intra-segment eliminations, okay, total others, intra-segment eliminations again. So what is happening is you have a segment reporting and intra-segment eliminations also. So you have two type of eliminations, intra-segment eliminations or inter-segment eliminations, and then the total comes which you can match with the FS. Okay, now this is automotive and other related segment. You have other segment. Okay, if there is some different company, different set of financial statement, you will have a different set of segments over there, and all these numbers and information is required to be reported. So you need to identify the segment information, then you need to review it, and then you need to see if there are any adjustment done, and accordingly you need to report the final numbers. What if there is a segment adjustment within the commercial vehicle itself, like there is an entity A, entity B, and they both have a transaction. So even for the purpose of segment reporting, you need to identify this adjustment performs or relates to the same segment. And let's say, for example, we'll go to our example of the different entities. Let's say subsidiary 1, 2, 3 and holding H1. Okay, let's say there is a H1 and S1 are this is segment 1, seg 1. Subsidiary 2 and subsidiary 3 is a segment 2. If a transaction between subsidiary 1 and subsidiary 2, this transaction, okay, this transaction basically is required to be eliminated for CFS. For CFS reporting, yes, required to be eliminated for CFS reporting, but not required to be eliminated for segment reporting, because then you will show intra segment or inter segment adjustments and accordingly you will eliminate that. So you need to see the impact of the adjustment within the segment itself. That becomes very important, identification of the segments. Now once you identify the segment, then what is the next step? Anyone? Once you identify the segments, what is the next step? Anyone? So segment identification, one thing. Then what is the next step? And I want answer from you guys. No? Okay. So basically, once the segment reporting is identified, once you identify all these things, what is required to be identified is the related party. Why related party? Reason because now the next step will be the transactions with the related party. Fourth, transactions with related parties. This is required to be reported as per Ind AS. Yes, same for the consolidated financial statement. Now, if you do not know who are the related parties, how will you report the transactions with the related parties? So I need to identify the related party and the transaction with related party. Identify the related parties and then the transaction with the related parties, so that when you prepare consolidated financial statements, you can say that, okay, we have reported all the related party transactions. You can say that you have reported all the related party transactions. Let us go and see. Just a minute. Okay. So there is some problem. Because of the bulky file, it is getting time to open. So once you identify the related party, basically, then you need to disclose all the transactions with the related parties. Okay. See over here. Now related party transaction. I need to report all the related party transaction. Now related party transaction with the associates and subsidiaries, joint arrangements and its subsidiaries, and the company and its subsidiaries and joint arrangement and total. I need to report all related party transactions. So I need to identify these related parties and then I need to report the transaction with them. Plus I need to give the details of significant transactions as per the Ind AS. Okay, with related parties again. So transaction, nature of a relationship, like what is the relationship with the related party, and accordingly the significant transactions. Plus I may also require to provide the list of related parties. So there is a list of related parties that I am required to report. It is also given in the this particular financial statements a list of related parties, list of subsidiaries. We have already seen. Okay, so which all subsidiaries are consolidated and which all subsidiaries are not. So that is already given. So you need to identify all these related parties, subsidiaries, joint ventures, so that you can report what are the related parties and the transaction with the related parties in the consolidated financial statements. Fifth, very important, very important, harmonization of the financial information. Okay, harmonization of the financial information. Why very important? Reason because this particular part over here, when I say harmonization of the financial information, not each and every financial information will be in a similar format. Not each and every financial information will be in a similar format. You need to understand which financial information is given, what is its outcome. I'll just show you an example. See, I will show you one of the balance sheet, and the liabilities and the equity, they are reported in the balance sheet. And this is something, the financial statement outside India, not in India. Again, publicly available information. Yeah. Sorry. Okay, this is publicly available information. Now see, this is something outside India, some other different country as of now. Why this is important to understand? We have something called over here in this financial statement is treasury stock at the cost. How will you consolidate? Where you will take? In the stockholders equity, you have a treasury stock. Where you will take this treasury stock? Where you will add this treasury to stock? Treasury stock at cost. Now these certain items which are different in the different jurisdiction, in different country, will appear in the financial statement. Yes, they will appear. And accordingly, you need to understand where should I show this. For example, again, another example of the cash flow statement, which is cash flow from the financing activity. Okay. Cash flow for the financing activity. See, this is cash flow from the financing activity. What we have over here. Let me zoom in for you guys. We have something cash flow from the repurchase of common stock under the financing activities. That is not there in India. How will you identify this thing and how will you show this thing somewhere else? Not only that, there's a consolidated changes of equity. Okay, you may have a stockholders equity schedule somewhere else. Over there, you will see again this kind of thing, repurchase of common stock. Now, how will you basically report this? How will you report this? How will you consolidate this? That's a very big issue. Another issue, that if you have a related party transaction reporting. Okay, if you have a related party transaction reporting, then if which is different than the related party transaction that we have in India, how will you consolidate that? So for example, I will show you a related party note from a relevant Again, publicly financial information which is there. See, this is related party mode. This is a listed entity outside India. Okay. Now, the question is, you don't have any related party transaction from the subsidiary or something like that. Do you have? Answer is no. Okay. You don't have that thing. And the problem is, in India, we have that requirement. So how will you consolidate this? Where will you take that? Whether it is from subsidiary, it is joint venture, or how it is, how will you show? We just now saw in our related party reporting, in our consolidated financial statement, we need this kind of information, that whether it is associate and its subsidiary, whether joint arrangement, whether what is the kind of thing where we can show it is it a transaction, okay, is it a balance? So I need to show in categories. If I don't have that category, I'm gone. I need to report this. In certain jurisdiction, you might not even have a related party transaction reporting. How will you report that? How will you consolidate that when you don't have the information at all? You have the financial information, but you don't have the information with respect to the related party transaction. Or you have a partial information in their financial statement. And there are scenarios, yes, you have a partial information, you have an information where uh, which is not appropriately disclosed. One classic example I will show you. Again, another set of financial statement from different country. Okay, over here, this particular entity, again, this is the publicly available information that we are talking about. So just a minute. This particular entity has subsidiaries. Okay, let's say if you are one of those company which has a entity outside India, which again has a subsidiaries over there, and that entity is not required to prepare consolidated financial statement, rather it is required to show the investment in subsidiaries like this. Okay, in this particular format, through fair value or through any other means which is there as per the local gap. How will you consolidate this into your financial statement? How will you consolidate? Because here you will not have the consolidated financial statement, rather a disclosure of the fair value of the investment which is there in the subsidiaries. You don't have information for the line by line consolidation. Different gap. We are talking about altogether different gap. Okay. Again, like here, these are recognized as a fair value. The investment in the subsidiaries are recognized as a fair value, or the fair value of this basically investment is recognized. Now how will you go for a line by line when you don't even have a line by line consolidation done by that particular entity as per their local gap? It is done as per the fair value. Different gap altogether. We cannot, until and unless we don't have information, we cannot consolidate as a management. And as an auditor, you will not be able to audit. Plus, again, one example, treasury shares. You will not see this concept in India. You will not at all see this concept in India. These are the shares of the company held by the company. Shares of the company held by the company itself. You don't have that. How will you disclose this? How will you account for this? So all these differences are there. All these differences will be there. Okay. And as a result, we need to align the financial statement. As a management needs to align these financial statements. Once they will align, then only the consolidation is possible, and that is known as the harmonization. I cannot basically directly add line by line whatever is given. It will not match at all. Okay. The things are altogether different. So in that scenario, I will not be able to match. Even if, let's say, for example, in this entity, I have bifurcation of this is related party transaction. I have transaction with subsidiaries. I have transaction with related companies. But again, how they identify the related party, that is very important. What criteria they use to identify the related party, that is important. What criteria they use to identify the segment, that is important. And over and above, what financial period we have, that is important. Do you have this kind of bifurcation of the financial period? In some cases you may not. Now here we have the breakup from April to March. Okay, in some cases you might not have that breakup. So in some other examples, you have for the year ended December. This is for the calendar year. For the December ended, how will you bring the numbers from April to March? That is the financial year that is being, reported by your entity, holding entity. Over there, this December number will not work. They will not. So you need to perform this harmonization. Now, harmonization will be based on alignment of gap. Okay, alignment with respect to financial reporting. If some information is given, not given, how it is reported, that one. Alignment with accounting policy. Very important, accounting policy. Why we need to align with the accounting policy? Anyone? Why we need to align the accounting policy? Anyone? Why accounting policy? Which law? If you say law, then which law? Anyone? No? That's where the gap is, that we need to understand which requirement is coming from where. Then only you will be able to see whether it is being followed or not, and whether we are able to appropriately audit or not. So the requirement comes even from the Ind AS. See, a parent shall prepare consolidated financial statement using uniform accounting policies for the like transactions and for the other events in the similar circumstances. That means if a particular company use some different set of accounting policies, I need to align it. Accounting policy, let's say for example, let's go to this particular company. Okay, and we will see the significant accounting policies. And we will see if there is a difference in the significant accounting policies or not, so that it will change the perspective. Okay. Now, these are significant accounting policies and the judgment that are being used by this particular company. Let's say I'm giving a hypothetical example, whether this company, let's say if we are, consolidating this company. If we are consolidating this company, hypothetical example, with an Indian company, then how the accounting policies will work. So one such example is this one. Useful life of assets. Okay, this is a material judgment. Okay, this is a material judgment basically, which is being taken by the management estimate. that how the account, like how the useful life is being decide for a particular machinery or a plant. It may be different. Now in India, we have to use different methodologies which are given under the company set. Okay, so accordingly we need to see whether it is in line with the company set or not. If it is different, then it can be different. Again, impairment of non-financial assets, we need to see whether it is in alignment with the NDS or not. Okay, financial instrument, a lot of things can be there where you can find a difference, and that will be there because there's a change in the altogether gap. Okay, so if there is a gap issue, if there is something different being followed, a different accounting policy being followed, then in that particular case you need to align the accounting policy. Okay, and there are multiple things with respect to the provisions, with respect to the revenue recognition, contingencies, segment reporting, how they are identifying the segment, impairment, a lot of things are there. So basically it's not only the accounting, it's not only the gap, it is the accounting policy, and then comes the alignment with the accounting period. These all things are required to be aligned, and then only you will be able to consolidate. Clear? So let's come to the study material on page number 2, which is the responsibility of the parent. Now, responsibility of the parent, just now we discussed, for the consolidated financial statement includes identifying the components, including the financial information of the components. I told you why. Where appropriate, identifying reportable segments. You also understood now why. Identifying related parties, obtaining accurate and complete financial information from the components so that you can consolidate, making appropriate consolidation adjustments, intergroup transactions, and then harmonization of the accounting policy and framework that we discussed, gap conversion where applicable. All these things are required to be done by the parent. And as an auditor, you are required to audit this, that whether this has been done appropriately or not. Whether this has been, done appropriately or not. So as a management of the company, management has to prepare all these things, perform all these steps, and then they are required to perform consolidated financial statement. And an auditor, we are required to audit all these things. Now, as I said, auditor is required to audit the consolidated financial statement. And the reason why, we saw the relevant section 129 where the audit requirement is there. And in the similar manner, the section 129 says is that the provisions of the audit will be applicable in the similar manner. Okay. 129.4 says that preparation, adoption, and audit of the financial statement of holding company in the similar manner will apply to the consolidated financial statements. When I say similar manner, that is, you need to have a auditor for the consolidated financial statement, which will be a auditor over here. That auditor is required to audit the consolidated financial statement in the similar manner. Means he needs to follow section 143 for the CFS also. What section 143 says? Responsibilities of the auditor? Yes or no? Section 143 of the Companies Act talks about responsibility of the auditor, powers, duties, and auditing standard. So it talks about what powers auditor has and what is the responsibility of the auditor for reporting. 143.1 matters, 143.3 matters. Yes or no? There is one such area in that, okay, which says that auditor has a right to access the books of accounts and records of the company, not only company, but its holding company, like the holding company, subsidiaries, and associate. So, if the company is a holding company, then the auditor has a right to access the subsidiary company's books and accounts also under section 143. That was the amendment which was already, incorporated, which was already brought in 2020. So now the auditor of the company has a right basically to inspect the books of account of subsidiaries also under section 143. Okay. So it is no longer something that, subsidiaries can deny, no, no, we will not provide the access. It is not like, it is not the case. Companies are required to provide the access now. Clear? So in case of a holding company, the auditor has a right to access the books of accounts of the subsidiary and associate company also. Now, uh, again, the point comes is, if the auditor has been given these rights, if the auditor has a duty to report under section 143.3 or on the matters of 143.1, what additional things auditor is required to do in case of audit? So now we will understand from the perspective of the auditor's responsibility. So when I say auditor's responsibility, basically, auditor uh, auditor basically is required to audit the consolidated financial statement the way he was doing the audit of standalone financial statement. That means he has to consider the standalone consolidated financial statement as a whole, perform the planning, risk assessment, identification of the materiality, assessment of the fraud risk, okay, how the consolidated financial statement is prepared, okay, and then on the basis of that, he needs to, perform or design all the audit procedures. He needs to identify the control which are used for the purpose of consolidation or preparation of the consolidated financial statements. He needs to test those controls. He needs to perform substantive procedures. And then as a result, okay, after all the evidence he has gathered, he needs to issue the opinion on the consolidated financial statement. Okay. Based on all these things, then he will issue an opinion on the consolidated financial statement by complying all the matters which are there under section 143.3, 143.1, and he needs to gather all that information also so that he can perform the reporting under section 143.3. Okay. So let us see the responsibilities of the auditor. Again, stick. Just a minute. uh, Sorry for the glitch. Just sorry. No, just a minute. Let me reshare it again. It was stuck. Okay. So now basically we have the responsibility of the auditor for the purpose of consolidated financial statements. Okay. I hope you can see the screen now. If not, then just let me know if you can see the screen or not. Okay. Let's come to the page number. Basically, page number 13.9, audit considerations. Now, audit consideration. Now, whatever we have discussed for the purpose of consolidation, all these things are applicable over here. So first of all, we need to understand the consolidated financial statement are prepared on the basis of the financial statement of parents and its component. Okay, that is the first thing that we need to understand. By using the consolidation procedures prescribed under the accounting standards. Now, accounting standard and applicable financial reporting framework basically is the one that is we just now discussed in the AS 110 and all the relevant part of the Companies Act. Second, we need to use the work of other auditors. That's where we need to understand an important standard, which standard is this? Can anyone tell me the name of the standard? Which is this standard? Anyone? To use the work of another other auditor, I need to use a particular standard. Right? There is a standard on auditing on this particular topic. I need to comply with that. Which that standard is? Anyone? Very good, Radha. So that is SA 600. Okay, SA 600 is a standard that I'm required to follow for the purpose of using the work of another auditor. That's very important standard that we need to understand. Okay. Now, when I talk about this particular standard, this standard lays the responsibility of the auditor when we are using the work of another auditor. So if we are using the work of another auditor, then we need to follow SA 600. And SA 600 provides some important things that we need to discuss now. Okay. So what SA 600 says basically, using the work of another auditor. Okay. So if when we are using the work of another auditor, now who is the another auditor or other auditor? And who is the main auditor? So here we will divide into the principal auditor and the other auditor. Principal auditor means the auditor with the responsibility for reporting on the financial statement of an entity that includes financial statement or information of the one or more components audited by another auditor. Okay, so principal auditor, in other words, for simplification, is the auditor of holding. Because holding company's financial information, that is a consolidated financial information, okay, this financial information of that particular entity will include the financial information of components. Financial information of component, that's a CFS. So you can say auditor of the holding. We are talking about as of now principal auditor. Now when I talk about this term, other auditor, another auditor basically, or the term which is used is other auditor over here, okay, or another auditor means an auditor other than the principal auditor. Okay, now whose responsibility is to issue opinion on the financial information of a component, and that financial information is audited by included in the financial information which is audited by the principal auditor. Basically, other auditor is nothing but, you can say, component auditor. Because components financial information will go to the holding and it will become the consolidated financial information. Component means division, branch, subsidiary, joint venture, associated enterprise, or any other entities whose financial information is included in the financial information audited by principal. This is very important. Because if I say it's a division, and if there is another auditor for the division, SA 600 will trigger. If there is a branch and if there is another auditor of the branch, SA 600 will trigger. Subsidiary, joint venture, we already understand. Associated enterprise, we already understand. But it extends to the granular level of the division and branch also. That is important. And that's why we use the term component, not subsidiary. Because if I use the term component, it includes all these things: division, branch, subsidiary, joint venture, associate enterprise. But if I use the term subsidiary, it's only subsidiary, which is restricted, which is not correct. So I need to use the word component. I need to use the word other auditor. I need to use the word principal auditor. Okay. Instead of auditor of holding or subsidiary. Okay. You need to understand from which perspective you are writing the answer. If you are writing the answer from perspective of SA 600, then SA 600 is not only applicable to the consolidated financial statements. Yes, it is also applicable to the consolidation of branch accounts which are audited. Okay, branch accounts which are audited. So if you are writing an answer from the perspective of the SA 600, you need to use these terms: principal auditor, other auditor, and component. But if we go to the Companies Act, Companies Act use the word holding company, and consolidated financial statements, plus the term subsidiaries, if you see one or more subsidiaries. So the Companies Act use the word subsidiaries. Even if you go to the Rule 6, what it says, that wholly owned subsidiary. Okay, so holding company, because here we are talking about at the company level. So we will be using the term holding company, wholly owned subsidiary. If you go to Ind AS, okay, here the word which is used is a parent. The term which is used is a parent company, a parent. And again, for the components, if you see, so here if you see, it is all the entities, like entity or the components term is used in the case of Ind AS 110 also. Again, subsidiaries also is used. So you need to understand what terms are used and how you are writing the answer from which perspective. Now, if I write the answer that which companies are exempt from the perspective of the, let's say, Ind AS 110, I cannot use the term component over here because it will have a separate meaning. Now, in Ind AS 110, the term which is used is wholly owned subsidiary. Okay. Or if the term, if you see, it is used the parent. So holding company, no, I need to use the term parent because it may include a lot of things. I may use the term holding and subsidiary, which is there in the company set, and principal auditor component, which is there in the standard SA 600. So accordingly, I need to understand what are the terms which are required to be used for the purpose of answer and from which perspective I'm writing the answer. Okay, so that is component, principal auditor, and other auditor from the perspective of SA 600. Why SA 600 provides the responsibility of that when you use the work of another auditor, what responsibility is there of the principal auditor. Okay, how principal auditor can rely upon the work which is performed by another auditor. One critical exception where this SA 600 will not be applicable is a joint audit. Remember that. So this standard will not be applicable in case of a joint audit. Nor this standard deals with the responsibility of the predecessor auditor. So joint audit, out of the scope. Clear? Now, when the principal auditor, now we are talking from the perspective of standard, okay? When the principal auditor used the work another auditor, at that point in time, first of all, what principal auditor is required to do? As a auditor, let's say as a auditor of a holding company, what you will do? What is your responsibility? First step, tell me. What you will do, what you are required to do before you start the audit, okay? What you are required to do? Anyone? Understand the nature of business? Okay, very good. I will understand the nature of business. Materiality, yes, very good. Materiality, okay. Anything else? What else I am required to do? Anyone? Perform risk assessment, yes. Component of FS, okay. I need to identify the component. Anything else? Anything else that I'm required to do? No? Okay, let me tell you. See, before I start the audit, even before I understand the nature of the business, I need to understand first and foremost thing, am I the principal auditor? Okay. Before accepting the responsibility of the principal auditor, he needs to satisfy himself that he or his role as a principal auditor will be appropriate or not. Should he accept as the role of principal auditor, the auditor, whether the auditor should consider that his participation would be sufficient to act as a principal auditor? That means I need to identify, is there any further holding or not? If, let's say, for example, if should I be the principal auditor, or should I be the component auditor, or what is my role? I need to understand from that perspective. Okay. Why here this particular discussion is there? Because when you understand the principal auditor, most of the time students have in mind is we are talking about holding subsidiary relationship. Okay, we are talking about holding subsidiary relationship. So let's understand holding subsidiary relationship and the role of principal auditor. So let's say now we are talking about SA 600. So let's say there is a holding company. Okay, one, there is a subsidiary. Two, there is a subsidiary. Three, third entity. Okay, there is a subsidiary. Four. Now auditor, let's say XN company, YN company, ZN company, okay, AN company, different auditors. What you will say, sir, by default, X will be the principal auditor. He has to, because X Limited, which is, because the holding company is required to prepare CFS, so X will act as the CFS auditor of the CFS. Same logic, pretty much straightforward logic. Why he needs to consider himself whether his participation will be sufficient or not. Now let me change. So let's talk about same company, one company, which is ABC Limited. Okay, this is a separate example. It has a division 1, division 2, Division 3, Division 4. Now, ABC Limited has an auditor, okay, which is XN company. Division 1 and Division 2 are being audited by YN company. Division 3 and 4 are being audited by ZN company. Now let's talk about that the Division 1 and 2 contributes 90% of the CFS. This is 5% of CFS, and this ABC only has a corporate functions. Now tell me, who should be the principal auditor over here? Who should be the principal auditor? Five percent of CFS, and the rest of 5% is corporate function. Okay, who should be the principal auditor? X, Y, or Z? Technically, Y. Why? Because majority of the audit is being done by Y. Materiality portion. Majority business is being understood by Y. Risk assessment, majority is done by Y. X is only looking for the corporate functions. Z is only looking for the 5% of the segment. I'm talking about the same company. That's where, okay, when I talk about the component and the principal auditor, you need to expand your horizon and you need to understand from the division perspective, branch perspective, and the subsidiary perspective. In some cases, it will be similar. In some cases, it will be easy that, okay, it's holding Action company will be the principal auditor. In some cases, same company, 3 auditors, different division, corporate function, division 1, 2, 3, 4, 3 different auditors for division. In that case, who will be the principal auditor? Now, some may say that, sir, is it not a joint audit? It will be a joint audit if I bifurcate my financial statements and the line items of the financial statement. I'm not saying that you do the fixed asset and you do the receivables. No. Here, the financial statement of the divisions will be separate. So, separate financial statements will be prepared for each division. And they will be audited separately. And then there will be one auditor who will take up all the divisions' financial statement and then consolidate. So it's not a joint audit. It's a separate audit which is being done for a division level. Separate financial statements are prepared. So it's not a joint audit as of now. Okay. I'm not saying that you do the trade receivable or you do the this particular area. In case of a joint audit, you do not prepare a separate financial statements. And there is a scenario where there is a separate audit report, but again, that's a restricted scenario. Here you have a separate financial statement, separate audit report. Okay. Now, that's where the auditor needs to understand whether his participation will be sufficient to act as a principal auditor. Okay. So he needs to understand, auditor needs to consider that whether the participation of the auditor's own is sufficient, will be able to act as a principal auditor. Okay, whether the auditor's own participation is sufficient to be able to act as a principal auditor or not. So that depends upon the materiality, okay, portion of the financial information, principal's auditor degree of the knowledge, risk of material misstatement, performance of the additional procedures that is required to be done. A lot of things are required. So you need to understand, should I ask YN company to be a joint, to be a principal auditor with me, or am I sufficient? I have all the information, I can proceed it. Or should I, ask YN company to be the principal auditor to take up the entire audit and I be the component auditor? Because that is the first step as a principal auditor you need to understand. And then rest of the portions will come into the picture. Okay. For the rest of the portions, when I talk about, you need to, first of all, when you are planning to use the work of another auditor, you need to consider the professional competency of that other auditor. For example, what if this ZN company is based in, let's say, foreign other country? Okay, if ZN company is based in other country, so this is not a CA firm. You need to think from that perspective. Okay, so what is you need to consider the professional competency of the other auditor, and then accordingly you need to decide how much additional work you need to perform on that particular financial statement. Okay, then you will go for materiality and all the other things which are there. Radha, can you just like reframe your question? And I'm a bit confused. Like, is it possible for joint audit and SA 600? Can you elaborate more on the question? Okay. Now, once we decide, okay, that we will be using the work of another auditor, then we will go to the materiality. Okay, after considering that, okay, the auditors is fine, it's competent, then we will go and will use the work of another auditor. We'll start the planning. We'll do the materiality. We'll find out the materiality and how the materiality is required to be calculated. We will understand that. So when I talk about the materiality now, okay, simple. If I talk about simple steps in the materiality, I will calculate first materiality as a whole for entire group, entire CFS. Okay, materiality as a whole for the entire CFS. I will calculate this based on the information that is provided to me. Okay, based on the information as a group as a whole, I will calculate the materiality, and that will be based on the entire information that is given to me, the unaudited consolidated financial statement. Now, once I calculate this materiality at the group level, I need to determine what is the materiality that I need to provide to the each component. Okay, so I need to then determine the materiality at the component level. I will just tell why it is necessary. Once I will compute the materiality for the each component, then I will do two things. Number one, I will first of all identify the material components. Second, I will inform the another auditor that this is the materiality, and accordingly you need to provide me the audit. Basically, you need to perform the work accordingly. So once I determine the materiality as a whole for the entire CFS or at the group level, I will break it down. So I will calculate materiality at component level. And this materiality at the component level will be provided to each component. Then each component will be provided materiality. Now the reason because is, if I have identified materiality at the each component level, accordingly the another auditor will audit on that materiality level. Okay, simple example. Let's go to the example that we discussed in the start, where we have the financial information also over here. Let's say the overall materiality is 1 crore. Okay, but that is of the holding company. Now, let me remove this. I discussed that this materiality cannot be applied because this is at the holding level. I need to calculate materiality at the CFS level. Let's say 1% of total turnover is the materiality benchmark I decided. So 1% of the total turnover will be 1 point over here, 12.2 CR. Okay, that is the overall materiality that I have determined. Now I need to break this materiality and need to calculate materiality at the component level. So the component level materiality, let's say for example, this is 300 crore transaction, this is 700 crore transaction, this is 120 CR transaction. Okay. Now, after consolidation, this is, I will bring something different. Okay. I will bring a different thing over here to make it a bit complex and to make you understand. Let's say turnover after adjustment, consolidated adjustment, intergroup transaction. So let's say the turnover is 100 CR. Okay. 300 CR or not 300. I will say 180 CR, 700 CR, 0. This is entirely the segment component 4 entirely provide the sale to the component 2 or basically subsidiary 2. So C4 entirely sales to the C2. That's why I removed the basically turnover. Sorry, here it is 300 only because it will be counted in the purchase, not in sales. So I need to remove here the sales and here it will be purchase. Okay. So what will be the consolidated turnover? 100, 300, 400, 1100. So 1100 will be the consolidated turnover, and of that will be the 1% materiality that I need to take, not the this 12.2. Instead, it will be 11 CR. Now, individual materiality, if you see of the entity that the individual auditor will calculate on the 1% of the turnover. Okay, so here will be 1 CR, 3 CR, 7 CR, and 1.2 CR. The respective component auditor will calculate, but from the consolidation perspective, will I allocate any materiality over here? Here there is no turnover. So accordingly, I need to select another benchmark for this entity, not the benchmark based on the turnover. I may take up, let's say, the entire, consolidated materiality is 11 CR. I may allocate 7 CR over here. I may allocate 3 CR over here. I may allocate 1 CR over here. What I will allocate over here? There is no revenue. I need to calculate another benchmark. Let's say 0.5% of the total purchase, because that is from the unrelated party. And that may come up to, let's say, not 1.2 CR, but it may come up to, let's say, 0.8 CR. So the component will now have a different materiality for CFS purpose compared to the materiality they were having for the standalone financial purpose. That's why I need to allocate the materiality at the component level. And they need to perform the audit according to that. Now, this materiality will be, divided into performance materiality and some other lower levels. Okay. And then according the work will be performed. I may do something more. I may do also a rejig. Instead of 7 and 1 CR, I may allocate only, let's say, 3 CR materiality. And instead of 7 CR, I may allocate 5 CR materiality. But you will say, sir, why you are doing this? Why you are allocating more materiality compared to what they are allocated for the purpose of their standalone financial statement? Why you are taking higher benchmark? Simple reason. Instead of 1% of the turnover, I can take any other benchmark. Let's say this 100 crore is a fixed revenue. That means the revenue is from the lease or rental property. where there is a very less risk, I may take up a higher materiality. But this 700 crore is from the government projects where there is a higher fraud risk. I may provide a low materiality. So it is not necessary that your materiality will be similar to what you have as standalone financial statements. And accordingly, I need to communicate to each auditor the materiality, and I need to identify that, okay, whether what additional work these individual auditors are required to perform. Because earlier, the sample selection was done on this basis by the standalone financial statement. Okay, for the audit of standalone financial statement, they did the sample selection on this materiality. For the consolidated, they need to select this materiality and they need to test higher samples. So the auditor has to work accordingly based on the consolidated materiality provided for the consolidated financial statement. Plus, I need to provide them additional information that they are required to provide me because of the different accounting gap, accounting policies, different reporting requirements, everything. Okay, so based on all these different reporting requirements and based on all these different reporting policies, I will give them the materiality. I will give them the additional information that they are required to perform. Let's say there is component 5. I will bring up a component 5, a small component. Okay, C5. Now this component 5, let's say newly acquired subsidiary. So this newly acquired subsidiary or newly incorporated subsidiary, wholly owned subsidiary of the parent company, has the turnover of 1 CR. Net worth of 1 CR, not much. Simple. Net worth, turnover, same. Okay. How much materiality I will allocate? How much materiality I will allocate? Anyone? How much materiality I will allocate over here? The 1 CR transaction which is there, it's a normal sale transaction. Let's say some items or goods were sold. Simple transaction, which is a simple sale transaction of 1 CR turnover, no complex revenue. How much materiality I will allocate? I may not even allocate a materiality because this particular component is not material for me. My entire materiality for the consolidated financial statement is 11 CR. This component's entire turnover is less than 11 CR. It is not material for me. Or let's say even if it is not 1 CR, let's say in certain scenarios you have a consolidated materiality at, let's say, 100 CR, and there's a component who has a sales in lakhs. Those components are not material even. So you need to identify which component are material and which component are not material. Okay. So that kind of identification is required to be done. So this is with respect to materiality. Okay. On page number 13.11, what we discuss is compute the materiality for the group as a whole. Okay. Considering the appropriateness of the consolidated adjustment, for example, that 120 or sorry 180 or 120 CR intergroup sale. Okay, and the group as a whole materiality which was 12 CR. The parent auditor can use the materiality on the group level to determine the component financial statement are material to the group. For example, your component 5. The principal auditor needs to compute materiality at component level. We did for component 1, 2, 3, and 4. Okay, and obtain certain confirmations from the component auditor like code of ethics or independence, because I need to see whether they are, they are competent enough. If it is not a CA firm, whether they are independent, whether the auditor basically is, performing the audit based on certain standards or not. Okay, so I need to see whether they are competent, whether they are maintaining the confidentiality, independence, code of ethics, all these things. If they are not the chartered accountant, okay, or they are not the Indian auditors, if they are outside India, then I need to check for this also. And accordingly, I need to, provide them additional information that, okay, this is something you need to provide to me. And as I said, once you do that, you need to then apply all the procedures. Like, first of all, you identify the group structure, okay, group wide controls, IT controls, whatever we have discussed. Understand the accounting policies of parent. Why? We saw just now in the AS 110 that requires that you need to prepare the consolidation by using the parent company's accounting policy. Okay, nature, timing, and extent of the audit procedures that is required for the consolidation. Use of the work of another auditor, SA 600. Okay, and coordinating the work to be performed with them. All these things that we understood right now. Clear? Any doubt till now? Any doubt? So there is one doubt. Joint audit can still be performed in the same division, though the principal auditor is there. So what should be understood? If the separate financial statement is prepared, then the principal auditor arises. See, if you're doing a joint audit in a division, it's a separate financial statement. Okay. For the purpose of component or for the purpose of principal auditor who is doing consolidation of all the divisions, he will apply SA 600. And at the division level, it will be SA 299, joint audit. Okay. So this is how it will be prepared. So the the current screen that you are seeing is on the page number 13.12 of the study material. 13.12, and over there you have a table of this. Any doubt till now? Yes, you can ask rather. You can unmute and ask the doubt. Hello. Sorry, you are on unmute. You can speak. Okay, if you are not able to, like, there is some technical error, you can write. Not an issue. Wait a minute. Just a minute. You can ask if there is some technical error, then you can write it down. I'll check if I can, allow unmute to you. I have para 4.3. You said company, and you said company listed, so they brought IPO. Then what about applicability? Para 4.3, like what you are referring to the para 4.3? Can you just explain a bit? Of company accounting rules. Uh, so the rule 6 you are talking about, this one, rule 6, this one, the ultimate or intermediate holding company files a consolidated financial statement with the registrar, which are in compliance with the applicable accounting standard. So you are talking about, okay, NDS. Okay, NDS basically. Just a minute, let me go. Para 4.3, this one. It did not file or nor is in the process of filing the financial statement with the Security Commission or any other regulatory in the public matter. Yes. If they bring this kind of IPO, they will lose the exemption. They are required to prepare consolidated financial statement. So they will not be able to claim this particular exemption, and they will be required to prepare the consolidated financial statement at the period end. I hope I have answered. Any other doubt? Then the materiality of 1 crore you said of not assigning any benchmark. Uh, so when aggregated, then it will cost. Let me see if I can. Sanket ji, if you can allow the students to unmute, is it possible, Sanket ji? Yes, Radha. See if you can unmute now yourself. Okay, there is a term technical glitch, because of which the audio features are not working. Okay, that's right. So it will be worked upon, and it will be resolved. But there is some technical glitch on the audio features for today. So that's why you are not able to unmute. Okay. So let's see your question. That then the materiality of 1 crore, you said not assigning any benchmark. When aggregated, then it will cause material pervasive effect. Yes, it will cause. It's not something that I need to see on a standalone basis. But see, I was talking about that. Let's say if your materiality on a group level is 1,000 crores, and you have a component at the, let's say, 70 lakhs of turnover. For that particular purpose, you need to identify what is material or not. See, I need to consider, let's say, for example, if this 1 CR entity is there, what other misstatement I'm expecting based on my experience, based on my past audits, or based on my previous experience from this audit, considering altogether expected level of misstatement. Okay, so based on that, I need to take decision whether this is material or not. Any other doubt? Yes, that depends upon multiple questions. Okay, whether the standalone basis, is there any other expected misstatement or not? If there is, then not assigning a materiality will be incorrect. But if there is no any other expected misstatement from the audit, okay, and this is the only thing, component you are excluding, there is no other component being excluded, you can easily, say this is immaterial for me. Any other doubt? You can write the doubt, because the audio features are basically not working through due to a technical glitch. So I would request, if you have any doubt, please write it down. I will take up. The notes will be shared once the chapter will be over. So when this chapter will be over, after that, this chapter's note will also be shared in the group. Any other doubts? Anyone else? You can write in the chat box your doubts and I will be taking up accordingly. Okay, if no further doubts, so okay, if no doubts, then what we do is the homework for you for the next session. We will continue this chapter number 13. Okay, we will discuss further on this. What I want you to do from your side, read whatever we have, read the chapter, because a lot of things we have already discussed in the chapter itself. Okay, for example, if I just show you quickly, okay, we have discussed already all these things, so it's require a reading now from your side. So this particular investment entity part, we discussed this. Okay, we discussed on the consolidation part. Okay, like the exemption which is given under the rule 6. Okay, then we discussed about the AOC one. Okay, we discussed on the how consolidation is basically done, the consolidation example. We discussed on the SA 600 part. We discussed on the exemption which is given basically for not consolidating this wholly owned subsidiary securities listed. I want you to go through that companies accounting standard rule which is there. Okay, again Ind-AS 110, we have discussed on that. So go through that, go through and read about the permanent consolidation adjustment, current consolidation adjustment, something we have already discussed out of this. Intergroup interest, okay, then like adjustment relating to the harmonization of different accounting policies. Then there are adjustment related to the financial statement of subsequent events, date of the auditor report. Read it, because when we will discuss in the next session, you will be have a good idea of it. For example, components local GAAP, okay, equity attributable, we just saw treasury stock example. A lot of things being already discussed. So read, and when we will discuss in the next session, you will be able to understand furthermore. So there is one question, Indians must go through in detail of the stated one for this chapter. Yes, because to understand what is applicable financial reporting framework, you need not only need to understand the Ind-AS, but you need to understand Schedule 3, what is additionally required to be reported for the purpose of consolidated financial statement. Can you please share the chapter 13 PDF so I can read it? It is available on the BOS portal already. So if you go to the BOS portal, the entire study material is available. All the chapters in PDF, you can download from there, you can refer it. Do we need to refer the CFS report of the company too, along with the reading of module? See, CFS report is for your own and better understanding that we are sharing over here. I would suggest first read the chapter. Okay, read the entire chapter, and if you need further understanding, then you go and see the real life example. It is a real life example which is there for you. Not only one, there are multiple annual reports out there. So to better understand, the real life implementation of this particular consolidation, you can, yes, definitely go and read the annual report. But first read the study material. Clear? And then in the next session, we will continue, discuss further, and we will solve some questions on this topic, because once you have the understanding, basic understanding of the consolidation and the group audits, you will be able to answer the question definitely. Clear? If no further doubts, then I propose to keep the session till here. We will discuss further in the next session. Okay, guys? So thank you. Thank you for participating in today's session. I will see you in the next. Thank you. Yes, session over.
Recording stopped.